Welcome to another episode of the You Can Only Be You podcast. I'm your host, Jacoby. This week, we are going to cover the financial baseline. Now, the financial baseline is broken into 5 categories, which I stress the importance of each category, and you should follow it to this domino effect, in my personal opinion. Once again, disclaimer, please do your research on all these things and apply to what best fits you and your journey in this particular time in your life. Now, 5 categories. Number 1, emergency fund. This is to cover life's what ifs. This is our nest egg. What if I lose my job? What if my car gets totaled? What if I can't have money coming in from one job? What if I get hurt? What will my life look like? I need to maintain my same lifestyle for at least 6 months to figure things out. Once again, the nest egg is the vital piece in attaining wealth. Anybody can get rich. Anybody can come across a windfall of money. Wealth is about keeping it and growing it. The difference between financial literacy, everybody can be literate, but it's financial discipline that's the key. So the emergency fund, the nest egg, is a pivotal aspect in getting to your financial goals. It's always the what if, and if things fall, any other asset fall, you still have this cash to fall back on. Emergency fund. Number 2, life insurance. Now, with covering life what ifs, you always want to be able to leave an estate or a type of lifestyle that can be maintained without you being around. For instance, if you leave, what impact does that have on your family? Death is one of those things where everybody eventually has to die. We don't want to leave our family with burdens, funeral expenses. If you owe money, if you're in debt, that can be passed on to your kids and things and so forth. So life insurance is a way to make sure they're able to maintain your same value of life that you provided while you were here, but also it leaves assurance that they can use this money to better their lives, and also a foundation. It's the quickest way to leave an estate. You have 2 types of life insurance. You have whole life and term. Me personally, I'm an advocate for whole life, although get what fits your current lifestyle and at this particular time. For instance, term life is for a duration, which is usually 30 years. So if you die within that 30 years period, you will have a death benefit paid to your beneficiary. Whole life, however, is different forms of whole life, but the whole life is permanent, meaning it's for your whole entire life. It's not just for a fixed period. For instance, if I have a term year 30 and I'm 35, I don't plan on dying at 65. So whole life would make more sense, but also whole life has a cash value that you can always borrow against. Another conversation, another topic. Number 3, HSA, a health savings account. Now, the reason I put this as number 3 as part of the baseline is because when covering life's what ifs, it's always that probability if you get sick. Long-term health care is real. People come across illnesses, especially with the COVID-19. Are you going to be able to pay your medical bills? Because medical bills can be a road to bankruptcy very, very quickly, along with student debts. But with the health savings account, there's a few benefits. 1, it's pre-tax, so it lowers your tax bracket. This is money you're going to be putting into it prior to you paying taxes, so right as your check comes. Also, it has a employer contribution. So typically with an HSA, you have to have a high deductible healthcare plan. Now, the HSA would allow you to put money up every check, pre-tax, that it builds in this account. HSAs now come with a debit card, so it's allow you to pay for any medical expenses. That's the benefit. Any medical expenses you pay for with this account is completely tax-free. If you use it for other purposes, you will face some penalties as well as taxes. Now, the benefit to a HSA, it rolls over every year, and the maximum contribution is $3,600. So it's relatively easy to put $3,600 into this thing every year and just have it roll over. And at age 65, when you're officially retirement age, you can use this money. Of course, you'll pay the taxes, but you can use this money on whatever you choose to. It's another way to accumulate wealth and also have a little nest egg, because medical plays a huge role as we get older and older. Now, number 4, which is my favorite bucket, a Roth IRA. Roth IRAs are a tax-free bucket, but also you have a 401k on the other side. Now, there's benefits to both. The 401k is pre-tax, so it allows your employer to make contributions as well that are also pre-tax, so it lowers your tax bracket at the end of the year. Now, with the 401k, max contributions are usually $19,500. Now, let's say you put that much into a 401k every year for 5 years. At the end of the 5th year, you probably have what was close to $100,000, and it can keep accumulating without you touching it. Now, taxes are deferred in the 401 bucket, so whenever you pull them out, you will pay those taxes and capital gains. Now, my issue with a 401k, now this is to each his own. Don't never over-contribute, because over-contributing meaning you're not paying taxes on that money now. But as you get older, you're going to be paying more taxes, and the more money you have in it, the more taxes you're going to pay. And a lot of people don't take into the account, as I get older, I have less deductions. I'm usually out of debt, meaning my car and house is paid off. My children are out of the home, or if they are living with me, they're not at an age where I can claim them. So my deductions are less, and I'm paying more when I take my RMD from my 401k. A RMD from your 401k is a required minimum distribution. So every year, once you're past 70.5, you have to take a certain percentage of your 401k, which is the RMD, to that account, or face a tax penalty of 50% by the IRS. So as you get older, when you're taking your RMD, your social comes into play. Now you have more income, less deductions, so you're in a higher tax bracket. Now, on the other side, you have the Roth IRA. Now, a Roth IRA is after taxes, so you're putting money into it after you pay your taxes, but it grows tax-free. So at any point when you grab that money past 59.5, it's completely tax-free. It's your money, and it's a bucket. It's one of the few buckets where you don't pay taxes on. Meaning life insurance and Roth IRA are, in certain real estate deals, are really the only type of money you really don't pay taxes on. That's the benefit of Roth IRA, which is why I put it at number 4. And it has a max contribution amount of $6,000. So every year, if you're putting $6,000, I think if you were to get a Roth custodial account for a minor or your child at age 16, let's say you put that initial $6,000 in there at age 16, you do not have to touch it again. Assuming that the child lives to their 65 and able to pull from this Roth IRA, they are considered a millionaire just based on one initial $6,000 investment. Tax-free. And number 5 in the financial baseline, brokerage account or money markets account. These are going to allow your money to not just sit like a savings account. These are going to allow your money to gain interest and grow. Brokerage accounts allows you to buy stocks or indexes, allows you to invest in different companies and ETFs, as well as mutual funds. The brokerage is the key to getting into the stock market. Money market account, which is also considered a brokerage. Let's say with your Robinhood, you leave money into your Robinhood and you have buying power. That's a brokerage account because it's accumulating interest faster than a regular checking or savings. So your money is not just sitting, it's growing every month, accumulating interest at a faster percentage and higher interest rate. Brokerage accounts is always the last thing because as you pay your bills, you cover your emergency fund, you make sure everything is in order, now you have money to invest. This is the money that you should be putting up religiously. Whether it's going towards individual purchasing of stocks or just sitting in this brokerage account or money market, it is going to accumulate interest and allows your money to grow and beat inflation, which is the #1 killer outside of taxes. Thank you all for being with me. I hope this helped you. Once again, your financial baseline. Make sure we have these 5 areas covered. I hope this helped you on your financial journey. You can only be you, baby.